Dividend stocks with poor earnings reports. I own a few of them. Earnings are coming in. They're coming in weak. Share prices are falling. And subscribers are wondering. They're wondering, hey, Ian, do you think these stocks are good buys right now? And so I'm going to discuss in today's video one of my favorite dividend stocks of all time, Clorox, maker of these Clorox wipes that I literally cannot live without, especially during the cold and flu season. Earnings came in poor, stock is coming down. People are wondering, Ian, is it a value right now? Well, I'm going to dig into the fundamentals today and I'm going to find out. Another one that I want to cover today is called Universal Corporation. This is a tobacco leaf farming company. Been in business for over 100 years. I own this stock. A lot of subscribers have asked me about it over the years. I haven't really talked about it too much, and so I have a lot of insights on that stock to share today and to share how I look at that company. I have another one, Hasbro. These guys make Play-Doh, and so this is a product that both of my kids love playing with. Play-Doh, this is an awesome product. Hasbro historically has been a high growth company. They came in with a very weak quarter, in my opinion. And the question becomes, is now a time to buy Hasbro or not? We will look at the fundamentals in today's dividend investing video. I have a bonus stock for you all as well. We're going to cover 4 stocks today instead of 3. Duke Energy, regulated utility company, electric utility company. Earnings, according to analysts, came in a bit weak. And so I want to look at that one. Quite frankly, I'm going to give you a heads up. I thought earnings were great. I think the analysts were expecting too much, but we're going to look at that one as well. So get ready. We're going to talk about some dividend stocks today that have had lackluster earnings. And let's look at the fundamentals and determine if they are solid buys, if they're solid values right now. So I'm going to start today with Clorox. This is the one that everyone is asking about. Look, it's the one that I want to add more to. I've been waiting forever to add more shares of this company. And so I think when this company falls in share price, everyone is wondering, is it time to jump on the opportunity? Is it time to seize the opportunity? I talked about this in a past video a while back where I like this seize the opportunity strategy. If a stock that I love tanks in share price and it's a good value, I will seize the opportunity immediately. And so let's look at some data. I'm going to share it on the screen right now. I just want to first look at a snapshot, if you will, of where Clorox is at. And so Clorox right now is trading at $145.30. This is down from the 52-week high of $167.70. So it's down about 13% from the 52-week high. Not a huge drop from the high, but look, for a premium company, a quality company, blue chip company like Clorox, it rarely kind of comes down at all. And so with the stock coming down, people are starting to wonder, is it a value? Well, let's look on. The dividend per quarter is $1.06. That annualized multiplied by 4 is $4.24 per year, which places the dividend yield at 2.92%. 2.92% starting dividend yield for Clorox. It's not bad. I would say it's certainly better than the low 2s. I'd like to see it in the 3s, but it's not bad. The 5-year dividend compound annual growth rate is 7%. So on average, over the last 5 years, they've raised the dividend 7% per year. I love that. And the 2020 estimate from analysts, the fiscal 2020 EPS estimate is $6.16. And so if I take the current share price, I divide by that forward PE for fiscal 2020, I get a PE right now of about 23. So a PE of 23 in this market for a world-class company like Clorox, is that a reasonable valuation? I would say it's kind of fair valuation. Deep discount on Clorox for me would be anywhere between, say, a PE of 15 and 17. But at 23, is it overvalued? Maybe a little. You'll see some of this in a minute when we talk about earnings. But more or less, historically speaking, about the long term with Clorox, I would say 23, it's kind of fair, if not slightly overvalued. So let's look at some more numbers. Payout ratio. The way I calculate this is I look at the dividend, which is 424, and I divide that into the analyst estimate for EPS, which is 616. The payout ratio is 69%. And so almost 70%, they are paying out, in other words, 69% of their earnings as cash flow back to shareholders like myself. I would not want to see the payout ratio get too much higher than this for Clorox. And so unless Clorox can grow their earnings at 7% per year in perpetuity, I expect that compound annual growth rate that we just looked at to taper off. I expect it to taper down. I don't think they can keep raising the dividend as much as they have unless EPS really kicks up and grows at a 7% clip, which I don't think is going to happen. You'll see more about this in a minute. And so let's, one more thing I want to point out, market cap. You'll see kind of a theme in today's video. A lot of the companies I'm covering today are actually smaller companies. It's funny. It's coincidental, I guess, but Universal, Clorox, Hasbro, all smaller companies. I have a special place in my heart as a dividend investor for kind of the smaller companies because my portfolio skews larger. Most of the companies that I own are large mega cap companies. And so the fact that some of these companies, the ones I'm covering today, are smaller, like I said, I have a special place in my heart for these companies, and I like to diversify many ways. I like to diversify by industry. I like to diversify by international exposure. I like some companies that are US exposure, some international, some that do both. Most of them, quite frankly, are both. And I like diversifying by market cap. And so I don't talk about this a lot, but I have a special place in my heart for companies like Clorox because it gives me exposure to a smaller company. And so I like that. So I want to highlight now just a few things that came out in their recent earnings, which they recently announced, I think just a week or so ago. The fiscal Q1 EPS, Q1 2020, fiscal again, is $1.59. Now, this was down 2% year over year, but it was ahead of analyst estimates. And so this company trading at a PE of 23 that needs to grow the EPS by 7% a year in perpetuity to keep up the dividend increases because the payout ratio is already up there, is shrinking. The EPS is shrinking 2% year over year. Now, let's look at sales. Net sales came in at $1.51 billion. And that was down 4% year over year. It was down 2% organically. This was worse than analyst estimates. And so they cited currency headwinds. I was a little bit surprised about this because I've covered Clorox here on my channel before. By the way, I'm going to give you a quick hack. If you want to find what do I think about any particular stock, go to YouTube, put in my name, PPCE in all one word, and then put in the ticker. It will pop up the videos that I've done on that company. I have covered Clorox before, and one of the reasons I like Clorox so much, and I still do because I think they just had one off quarter here, they're having one off year, they'll get it back. But historically, they've had a high growth rate. And historically, what was interesting is most of their business is in North America, United States. And so if they're citing, hey, we're facing some weakness here because of currency headwinds, I don't want to call BS, but look, I'm kind of calling BS. I'm sorry, Clorox. I love you. I got nothing but love for you, but I ain't mad at you. Just like Tupac. Got nothing for love for you, just like Heavy D. But I got to say, man, yeah, I'm calling BS here. Currency headwinds. Come on. Yeah, I know you guys are trying to grow internationally, but look, your business is here in the U.S. There's something going on here. And so maybe they're not selling as many Clorox wipes this year as they should be. Now, mind you that no stock goes straight up and to the right. No stock goes straight up and to the right. And I'm not talking about just stock price. I'm talking about the earnings. I'm talking about the revenue. I'm talking about the numbers. And so they're having something happen here that they're going to need to work through. Is it a buying opportunity? Hey, PE of 23 for Clorox. I don't know. Maybe if the PE got down closer to 20, I'd pick up some shares. Maybe I'll pick up some shares here. I'm hoping this thing becomes a value, because I love to add more shares. I've been waiting, but I don't know if the time is just yet. And so I want to look at a statement now from the earnings report. Clorox reiterated its outlook for fiscal 2020, which was lowered on revised assumptions of foreign currency rates on October 2nd. The company projects sales between low single digits decline and up 1% in fiscal 2020, reflecting about 2 percentage points of currency headwinds. However, it continues to estimate organic sales growth of 1 to 3%. Okay, so there's something good there. Organic sales growth of 1 to 3%. Hey, if they come in closer to the 3, that's about half of what would support eventually a EPS at the same clip, which would support a growing dividend in that 7% range. But honestly, currency headwinds or not, company ain't really growing here, according to this statement. Again, sales between low single digits decline and up 1%. Again, I would say this, a lot of people believe this, and I personally believe this. This may be foreshadowing what's kind of ahead. We're in the late stages of this bull market. I think consumers are starting to get savvy. Some consumers may start hunkering down here, being careful with their spending, being a little bit more frugal. You probably see the Amazon effect here a bit. You probably, being honest with everyone, see that white label effect, the generic effect, the store brand, if you will, effect. That being said, I love Clorox. I think there's room for everyone to play in this marketplace. I've talked about this at length before, but I'm just going to be honest with everyone out there. These numbers aren't that exciting. They're facing a slowdown here. Does it warrant a 23 PE? Maybe in this market, but it surely isn't a value. So I'm not going to necessarily buy more here. Maybe I'll pick up a few for fun, but small tranche, real small tranche if I do it. That's my take. Now, if I were starting over again, building my portfolio from scratch, and I wanted Clorox to be a core stock, yeah, I'd probably start averaging into Clorox here. But look, I've already got a well-built position in Clorox. Cost basis is way lower than here, and so that's where I'm at. All right, enough about Clorox. I want to move on to another company now. I want to talk about Universal Corporation. Universal is a tobacco leaf farming company, and they've been in business for over 100 years. This is a very small cap company. It might be the smallest I own in my portfolio. Let me pull this up really quickly. Market cap is $1.28 billion. Really small market cap. I love that about these guys. Not a very big company. It was weird. I was reading in their annual report, it cited the number of shareholders, and it was only 1,000 some odd shareholders. I kind of felt like I was in an exclusive group, if you will, owning shares in this company. Let me give you the background on this. Back in the day, when I got into Universal, why did I do it? I'm going to be honest with you. I got into it because of thug life investing. Seriously, back in the day, I was buying all of the SIN stocks, and I saw, hey, in addition to all the other SIN stocks, there's this one called Universal, and so I picked it up. Financials were pretty good, or okay, I guess I would say. But over the years of owning this company, I've done more due diligence, and I'll tell you how I look at this stock. I'm glad I'm finally covering this because it's a unique position in my portfolio. Quite frankly, I look at it more as a bond proxy, if you will. It's kind of a proxy for a bond. This company, from a growth standpoint, it doesn't have a lot of growth left in it, if any. Clorox, as by contrast, look, it's facing some tough quarters here, but they'll grow again. That's a growth company. Blue chip, solid, stable growth company. It will grow. Universal, by contrast, that company is not growing. And so why do I own this company? That's what I'm going to talk about a bit today. To foreshadow, I own it because it's basically trading at book value. I believe that the assets they're stating, the liabilities that they're stating are real, meaning they're not inflating the assets. When I look at shareholders' equity, which is assets minus liabilities, it's basically trading at book value. And so if they went out of business, I believe actually it's worth close to book value. And so that is comforting to me. It's kind of, like I said, a bond proxy, if you will. It pays a nice dividend. They tend to raise the dividend over time, although I don't think there's that much growth left at this point. And it's one of these stocks where I'm using the dividend right now just to pay for bills. It's one of the ones in my portfolio I turned off reinvestment. I'm using it to pay bills. I may even buy more Universal here, quite frankly, because I don't feel bad about spending it. It's one of those stocks like, look, Clorox, if I don't reinvest my dividends, I can't sleep at night. I feel bad about it. I feel like I'm doing something wrong. It's like I'm shortchanging the golden goose there. But Universal, hey, I don't want to insult you out there if you work at Universal, but it's kind of like, hey, I don't reinvest in Universal. I could care less. It's like, hey, it's Universal. Come on. So that's how I look at Universal. And so it's nice to have that kind of stock in the portfolio. And I'm kind of sharing something here with you I've never shared before. And I think it's good to share this for the reason that there's so many investors out there get obsessed with total returns. And look, I could sell my shares of Universal and instantly increase my total portfolio returns. I could do better against the S&P. In other words, Universal, it's weighting down my total returns in my portfolio. But I like having it because, one, it gives me that small cap exposure. Two, it gives me a company it's basically trading at book value that I think it's a real book value. If it went out, it's worth that. Three, it's kind of like just my bond proxy, if you will. I own it. It gives me a great yield. I can spend the dividends and use the dividends to pay bills, and it works for me. I consciously know it's lowering my total returns, but that's how I look at it. Now, I've also talked about this concept in the past of the trading range stock. This is a trade. You've been waiting. People have been asking me this like a year ago. Ian, what do you mean about trading range stock? This is a trading range stock. It basically trades in a range. When it gets towards the lower point of the range, I buy shares. I don't sell. So when it gets to the higher point in the range, I don't buy more. That's I just avoid buying. Here, I may buy some more Universal. We'll talk about the numbers in a minute, but I like it because it instantly gives me a lot of cash flow, and I'm spending that cash flow. So it instantly gives me more money to pay bills. I like that about Universal. So let me show on the screen some numbers right now about Universal. It is trading right now at $51. The 52-week high is $68. And so it's down 25%. I love that about Universal. The dividend per quarter is 76 cents or $3.04 per year. Dividend yield is almost 6%. 5.96. So they don't really have to increase it. I think the dividend is safe. Even if it's not, like I said, it's trading at book value, goes out of business. I believe it's trading low enough where there's some built-in margin of error there. And so anyways, they don't need to raise it. I like that 6% dividend. I use it to pay bills. Their 5-year dividend compound annual growth rate is 8% on average per year. That will not keep up. It just won't. And the reason for that is based on the trailing 12 months EPS. There's no forward EPS raise because the analysts don't cover it the way they do bigger companies. It's at an 86% payout ratio. That's all you're going to get. I don't think they can raise the dividend too much more. They'll do a token increase of like 1 penny per quarter per year just to keep it going, but I don't expect this 8%. PE ratio based on trailing 12 months is a 14. And it's a 1 billion market cap. And so why is this thing down? So let's look at Universal's earnings. Now, for the first half of the year, their fiscal year, it ends September 30th. So that's the first 2 quarters of the year. If I look at the raw numbers, last year for the first half, it was $1.76 EPS, earnings per share. This year it came in at $1.19. Now, the raw data, though, is adjusted. If they adjust, or needs to be adjusted, if you adjust it for GAAP stuff that throws it off, they're saying last year in the first half of the year, it was $1.65. This year, 2019 ended September 30th, $1.49. So it's down 10%. Now, if I just look at Q2, 2018 was $1.24, 2019 $1.11. So again, down 10%. So obviously, with earnings down 10%, the stock price went down, and it's creating a potential buying opportunity, in my opinion. What I've come to realize with Universal, and it seems like the management team even cited this, is one, earnings are very weighted towards the second half of the fiscal year. So this is just the first half. And the earnings can be a bit lumpy. The companies they sell to, the bigger sin stocks that I own, for example, their orders can kind of be a bit lumpy throughout the course of the year. And so it's a small company, revenue is concentrated. I wouldn't write off the year yet. And so that's how I'm looking at it right now. Okay, and so I want to look now at just a few financial reports for Universal. I know a lot of subscribers have been asking, Ian, can you include more financials in your videos? I've been doing this in the last few, and so I want to pop a few things on the screen. First, I want to pop up selected financial data from Universal. I believe I got this from their annual report. It was, fiscal year ended March 31st. And so what this shows you is fiscal years 2015, 16, 17, 18, and 19. And let's just look at some of these numbers. Top line, it's basically been in this range of kind of 2.2 million. It dropped down to 2.033 in fiscal 2018, back up to 2.22 in 2019. From a revenue standpoint, sales, this company is not growing. Again, could I sell this, redeploy the money in a company that's growing, increase the total returns in my portfolio versus the S&P? Yes, but not all companies have to grow. Again, this thing pays a nice dividend. It's a bond proxy. It's trading right around book value. We'll get to that in a minute. And so operating income, it's been up and down, but it's generally, honestly, through fiscal 2019, they had a rough year on that operating income. It was the lowest of the bunch, but it was not too much lower than fiscal 2015. Net income, fiscal 2019, it was a pretty rough year. That was their lowest of the bunch for net income, although it was also pretty low in 2017. And so you can quickly see here, quite frankly, when you look at these numbers, this company is not growing. And so I don't want to fool myself. I don't want to fool anyone out there. This is a different kind of company within my portfolio. At the time I bought it, the Thug Life in me potentially got a little carried away just buying all the Thug Life stocks out there. But over the years, look, I don't sell. And I've become kind of appreciative of this company from the fact that I don't need to reinvest dividends, and I'm okay doing that because it's not like Clorox where I just have to reinvest dividends. And like I said, let's see where the real magic happens right now because it's a different kind of company. And so I'm going to pull up the balance sheet on the screen right now. I'm going to start with assets. All right, so check this out. Cash and cash equivalents. You've got about $300 million in cash, or $297.5 million. This is interesting because this is a company, again, where the market cap that I just had up on the prior screen is $1.28 billion. And so a good chunk of that market cap is literally cash. What's next? Account receivable, $368 million. These receivables, I would say, are pretty reliable. You know who they're coming from. They're coming from the other sin stocks that I own. And so again, you add up accounts receivable, you add up cash, you are already pushing almost $700 million. And again, their market cap is $1.3 billion. So you've got some advances to suppliers, so on and so forth. They have inventories here. Check this out. Boy, do these guys carry a lot of inventory. $600 million in inventory. Oh my goodness. Some of that, quite frankly, I'm not as familiar with this business, but I wonder if the harvesting schedule, you just got to have that inventory because of how it goes. You may have a good year, you may have a bad year. There may be certain points of the year where orders are really high. Management has already said that the income can be lumpy towards the second half of the year, and so they probably got to just keep inventory on standby to have their business work. But look, this is good inventory. This ain't like Macy's where they're carrying fashions that are going out of fashion. This is inventory that the leaf they are farming, it is the leaf that is going to be used in the products that these sin stocks produce. And so they're carrying that inventory, and they've got some land, which is nice. If you go down further on this balance sheet, not a lot of land, but hey, $22 million, I'll take it. Buildings. They value those buildings pretty high, 260 million. Machinery pretty high to do their farming. I imagine that this machinery is probably of value because if it had to be sold to another farming outfit to farm something completely different, there's probably some value there. I could be wrong. But again, total assets for this thing. Well, before I even get to that, goodwill is not too high. I like that because goodwill is a joke. I don't trust goodwill at all. And so total assets of this thing come in at $2.1 billion. And so I like the assets side of the balance sheet very much at this company. I think it's realistic. I don't think they're blowing things out of proportion. Let's bring up liabilities now. And so that is the assets. Let me check the liabilities. So you've got some liabilities here, just notes payable, 50 million. You've got accounts payable, 145 million. Current liabilities aren't very high, 250 million. Where you get the liabilities on this thing, quite frankly, it's been a concern of mine from the get-go, from day one. This company's got some debt. They got 368 million in debt. And so you see that in the long-term debt. And so you add up all the liabilities, current and non-current. The biggest liability that would worry me with this company is the debt. They got a good amount of it. It comes out to 753 million. So what's left? If you scroll down even more, I show all this on the screen, the shareholders' equity. If you look at shareholders' equity, basically, if you take assets, you subtract out liabilities, the shareholders' equity comes to 1.337 billion. Again, the market cap right now is 1.28 billion. It's trading slightly below book value, and I believe this is a realistic book value of the company. So the way I look at Universal, very different than other companies in my portfolio. Is it a company I will put a ton of money in? Never. It will always be a very small portion of my portfolio. But I look at my portfolio, 43 stocks. They all play a role on the team. They're all team members. Different team members do different things. This is a team member that is really good at having that book value. It's really good at being a small company. It's really good at trading in a range. And quite frankly, it pays a hefty dividend that I can use to pay the bills, and I can sleep at night using those dividends to pay bills. That's what it does. So Universal right now, it's interesting. I never thought I'd buy more. It's at 51 bucks. When I bought, my best buys on Universal were at 45 and 47. It's getting close to the bottom of that range where I feel comfortable buying. And quite frankly, at a PE of 14, hey, it ain't great, but it ain't bad. I may pick up just a little Universal at some point. Just a little in the coming months. We'll see, but never going to be a core focus of mine. Certainly, it puts things into perspective, though. I like looking at these companies that are having lackluster earnings right now because you look at something like Clorox, PE of 23. You look at something like Universal, PE of 14, and you look at the book value on something like Universal. It's food for thought. Going into it, all day, every day, which one would I buy? You just ask me without even looking at the numbers. My bias would be Clorox because of the brand, the reputation, the blue chip nature of it. But you get thinking a little more. You look at the numbers, and you look at the numbers just a little bit differently. You look for things in the numbers that you don't always look for, like book value. You guys know me. I'm not a book value investor, but it does have its time and place in my portfolio. And so look, you kind of just look at the numbers. It almost makes Universal, to me at least here, look a little more attractive than Clorox. That being said, that earnings decline in the first half of the year ain't great. But again, it's lumpy. It'll come back second half, in my experience owning the company. So I want to move on now. I want to look at Hasbro. And so Hasbro is an interesting one. So again, this is a smaller cap company. I'm gonna I love Hasbro, by the way. Such a cool company, especially if you have kids. You know Hasbro. But Hasbro, again, a small company. It's so interesting. 13 billion market cap. And what I always liked about Hasbro in the past is the company's growing quick. Historically, it's been a company that was growing really quickly. Well, that ain't happening so much anymore. We'll get to that in a minute. But first, let me just show some numbers on the screen. So price per share is 95. It's down from the 52-week high of 126, so it's down 25%. Nice drop there. Wow, that's similar to Universal. So nice drop there on Hasbro. Dividend per quarter is 68 cents. If I multiply that by 4, it's 272. Starting yield is a 2.85%. That's been, quite frankly, one of the higher starting yields I've seen for Hasbro in recent years. So not a bad starting yield for people just getting into Hasbro. However, well, actually, before that, compound annual growth rate of the dividend is 10%. That probably won't hold up because the payout ratio is 70% unless they grow quicker. And forward PE on this thing is a 24. My goodness, the most expensive of the three we've looked at so far. And so I'm going to honestly, I don't want to call BS on this thing, actually. I call BS on Clorox, but these guys they're missing earnings. They missed analyst estimates. Revenue is up only 0.6% year over year. God, that's nothing. Adjusted earnings grew 2% year over year. How the heck I'm just being real. I got to be real with myself. Look, I own it. I love it. I ain't selling it. But the payout ratio is 70%. I love this company because historically they've grown the dividend quickly, 10% on average per year for the last 5 years. Awesome. How is that to continue if revenue is up 0.6% year over year and adjusted earnings are up 2% year over year? It's not going to happen. And so how the heck also does that does this work? Does this PE work at a PE of 24.59 when it's growing earnings adjusted 2% year over year? It doesn't work. And so am I buying more Hasbro here? No, it's overvalued. I think it's overvalued. I want to wait and see what happens. Now, I'll tell you there's two big risks with Hasbro. I'm going to talk about Disney today, actually. I'm going to talk about it a bit later. I don't own any Disney, but my kids do. I bought it on their behalf. And the thing about Disney now, with Disney Plus, I think Disney, who knows what will happen, but I'll just give you a foreshadow of a risk with Hasbro, potential risk, because I got to know the risks. I own it, I love it, but I got to know the risks. I got to be honest. I'm the only investor out there, one of the only ones that you'll see on YouTube at least, trash talking the companies that the very companies I own. I'm talking smack about these guys, thug life. I love them, but I got to be real with them. Tough love with these guys. Here's the risk. Disney, look at Disney Plus. They go with their own streaming service, doing well. They want to disintermediate the middleman. This is a classic strategy. Look at the hotels and the airlines. They used to go through these middleman like websites, compare all the prices. No, they said book direct for the best price. You know what Disney is saying now? Go direct, use our streaming service. Okay, where does Hasbro make a lot of money? Hasbro, and there's some drama about this over the years with Mattel. Mattel used to have this. They lost it. Mattel fell off a cliff because they lost it. Hasbro got it. Hasbro hockey sticked up because they got it. What did they get? They got the partnership with Disney. They produced those Disney toys, those Disney action figures. I'm Disney. I got Disney Plus. I'm trying to disintermediate the other streaming services. What am I going to do with my toys? Should I disintermediate Hasbro? Should I start making all my own toys? I don't need Mattel or Hasbro. I go myself. This, in my opinion, is one of the single biggest risks for Hasbro. And they've already faced some challenges with Toys R Us drama. They got through that just fine. But I'm just saying here, to be trading at this kind of PE in the market we're in now, with the growth they got, with some of these risks, I'm just telling you, keep your eye on Disney. They're doing some interesting stuff. Would I rather own Disney or Hasbro here? Disney, in my opinion, especially at these valuations. I don't own any Disney, but my kids do, and I'm really proud that they do. I'm going to talk more about that later in today's video. But that's where I'm at with Hasbro. I'm not buying Hasbro. I don't think it's a good value here. Though I'm going to hold it, I'm not going to sell it for sure. And I believe in it for the long run. And I buy and hold forever. It plays a role on the team. It gives me diversification into small caps, into this consumer discretionary segment. And quite frankly, they produce a lot of cool toys. And they got they got some interesting acquisitions. They did that whole acquisition of Peppa Pig, and along with it came Death Row Records, Thug Life. They own Magic the Gathering. They made that Wizards of the Coast acquisition, and so I think that's just huge. And so they got a lot going for them. Monopoly franchise, Play-Doh, list goes on and on. So we'll see. We'll just see. But they had a rough quarter, and again, could some of this just be foreshadowing what's to come? Look, I got companies that have had stellar earnings as well, but we're talking about the bad ones today. Tough love, giving them a hard time, being realistic about the stuff I own. It's not always looking good. Quite frankly, what I'm sharing today also is a microcosm into the journey of the dividend investor. I've been at this a long time. At some point or another, you're going to face this too. You're going to own certain stocks in your portfolio where the earnings, they're bad. And they used to be good. There are many years of good. Universal, just a few years ago, they had one of the biggest dividend increases, huge parabolic dividend increase one year. And it made me happy, felt really good about it at the time. But now I got them. Hey, they ain't doing so good in the first half of this fiscal year. And so again, microcosm into the life of a dividend investor. It happens. And what do I do when they face these tough quarters? I do what I'm doing right now. I look at the numbers, I'm real, and I have the tough love, but I'm buy and hold forever. I don't see anything here that's going to certainly scare me out of these companies, but I see some stuff here where it potentially points to the economy turning a little bit. And so it's just something to keep the eyes on. And so I want to move forward now. I want to talk about the bonus stock today. I want to talk about Duke. I like this one because these guys are doing great. I love Duke. And so I'm going to put some numbers on the screen. Duke Energy, regulated utility, awesome company. Price per share is $88.58, down from their high of 97, so they're down 9%. The dividend yield is 4%, 4.27. 5-year compound annual growth rate, 4%. And the PE is a 17.68 based on analysts' estimate of 5.01. Payout ratio, 75%. I would expect that with a regulated electric utility. Market cap, $64 billion. So certainly the biggest of the bunch other than Disney. We'll talk about that later. Duke, mind you, the analysts didn't like it. It didn't meet their expectations, but I think their earnings came in great. And so this thing is tanking, but this is the example of a company, quite frankly, right now that I think is doing great. I might add more. PE of 17, little lofty for regulated electric utility. But honestly, in this market, it's not. And I'll tell you, they came in at $1.79 EPS versus $1.65 EPS the Q3 prior year. That's an 8.5% rate, growth rate. Let me repeat this. Clorox. Let me just go back to these guys. I love you, Clorox, but I'm telling you, you got to step up your game. Fiscal Q1 EPS was down 2%. So Clorox, you are down 2% year over year. Okay, Universal, you're down 10%. Okay, Hasbro, you're up 2%, but that's not very good. My utility, the company you would expect, ain't going anywhere. Earnings are up 8.5%. That is just brilliant. And it's not good enough for the analysts. Come on. And what the analysts didn't like is their sales were no good. The revenue missed. Mind you, revenues at Duke were up 4.68% year over year. So revenues are growing 4.68. Best of the bunch. These guys are growing on the revenue and earnings. Not good enough for the analysts. And so they said their adjusted diluted guidance on EPS is 7%. Or actually that's year to date is 7%. They raised their guidance. They said long-term EPS growth will be between 4 and 6%. I see a lot to like here with Duke. I like buying regulated electric utilities. They play a role in my portfolio, and they give me current yield, current cash flow. A lot of investors are on the channel starting a bit later in life. They sometimes ask me, what would I do if I were hypothetically starting later in life? I would probably load up on some utilities. I feel like most utilities are overpriced here. I think Duke, given their stellar report, despite what analysts think, it's a reasonable value here. Now, is it a deep discount? No. Is it trading at a fair value? Maybe slightly below. I think it's kind of in that range, but I would feel good about buying Duke here. I might pick up some Duke. And so I feel good about that. Out of everything I've discussed so far, Definitely not buying more Hasbro. Duke, I feel probably the best about buying more. Universal, second best. Maybe pick up a few just for fun because it's kind of just, for whatever reason, it's just fun for me to buy Universal. I just kind of like owning it. I'll buy some more. Clorox, probably the next one, but it's a bit lofty at that 23 PE and not growing where it needs to grow. And so that's kind of the range. That said, I don't want to discount Clorox too much because Clorox never goes on sale. And if they're facing a hard year, hey, maybe I'll buy some Clorox because the growth, it's going to come back. I know it because they've got such good brands. And so I want to move on really quickly here. And I'm going to share, I know I'm jumping around. By the way, it's late in the night, Sunday night. I don't have the time I once did to do these videos. So I'm doing one a week now, basically, but I'm trying to make it longer, more involved, better, raise the bar, if you will. But I'm kind of jumping around tonight. I'm just doing my best as I can because I'm tired and there's a lot going on, but I love you all. I gotta do it. I gotta do my thing here on YouTube. So I want to talk about a few lessons, just investing lessons. And one of the lessons, I planted the seed about this recently in a video. And it went something like this. Investors get so scared. Hey, am I going to buy the stock here and it's going to go down? Just like some of these stocks we're talking about today. These are all stocks that are losers right now. They're stocks I own that are losing. I mean, Universal's down 25% from the high. Clorox 13%. Hasbro 25%. Duke 9%. They're all down. And so people worry, oh, I'm going to lose 25%. I'll tell you though, you buy anything like this jacket I own. This is an expensive jacket, Lululemon. I don't remember what it cost. I think it had to be over 200, 250, something like that. I don't know. And so anyways, what's it worth now? Nothing. It's worth something to me because I really like this jacket. But I'm just saying anything I buy is worthless. And so I want to point out Disney here because a lot of people, including myself, have avoided Disney because it's perpetually overvalued in my opinion because it's such a great stock. That's why I bought it for my kids, not myself, because they've got more years than I do. They got the time horizon needed to make Disney work. But let's look at Disney. Let me pop it up on the screen. Price per share, 144. It's basically near the 52-week high, only down 4%. Starting yield is abysmal. It's only 1.22%. Nothing. I can't pay for stuff on 1.22, but my kids can when they look 50 years out. Compound annual growth rate is 9% with a payout ratio of 32%. That will continue in my opinion. PE is a 26, so it's the most expensive of the bunch here. Very expensive stock. Quite frankly, I'm surprised Hasbro's at a 24 if Disney's at a 26. Maybe Disney's actually either Hasbro's overvalued or Disney's undervalued if you look at it that way. Market cap is pretty big. And so I want, and it's doing well. It's up on Disney Plus. What do I do for the holidays? I'll tell you what happens. I just cannot bring myself to buy my kids' toys. Thankfully, my wife has that covered. In fact, what I was sharing here, this Play-Doh, this is actually an unopened Play-Doh. This is one of the gifts that will be forthcoming for the Christmas holiday. And so my wife takes care of all that stuff, thankfully. Because if she didn't, I worry they may not get toys because I'll tell you, I refuse to buy the toys and I refuse to buy them because I understand they add value. I understand it keeps the kids busy. I understand the right toys are enriching, like Play-Doh. It's good for sensory. It's good for thinking. It enriches, it teaches. But for me, the way I kind of look at this stuff, and it's fun. I'll tell you, check this out. Mr. Incredible, represent Disney. We love Disney. We love you, Disney. Disney family. Anyways, we enjoy Disney Aulani Resort, by the way. I'll show a photo of that somewhere here. Loved it. Would love to go back. Brilliant, brilliant vacation. But I'll tell you, vacation, always money well spent. Stuff like this, good. It's enriching. Kids enjoy it. But I'll tell you, it's worthless as soon as you buy it. So the way I look at it is for Christmas, for birthdays, I just can't do it. I just buy the Disney stock. And I don't care if I'm buying Disney stock at a PE of 50. Look, if I'm buying Disney stock, it's money that is well spent, especially given their time horizon. But even if it goes down, say stock goes down 50%, hey, you buy toys, your money is down 100%. And so that is one way to look at it, not only for kids, but for adults, because I think so many of us adults, we get caught up. Oh no, I bought it and it's down 10%. Oh no, I bought it, it's down 25%. Who cares? Everything you buy is down 25%. Everything in your life, the jacket that you own, the shirt that you own, the toys that you buy your kids, everything. It's not down even, it's not only down 25%, it's down 100%. And so when you start looking at things that way, it opens up a world of opportunity in investing, and it gets you thinking a little bit less about valuation. And look, you know me, I have to buy value. That's how I do it. That's why I'm even with something like Clorox a little hesitant to buy now. Out of the list, I only kind of see Universal and Duke as the two I'd consider, just as I am a value guy. But I'll tell you, my kids, they've got a longer term time horizon. So what did I do? I bought them Disney stock for Christmas already. I actually bought it early. I had the money, and rather than have the money sitting around, I'd rather just get it deployed. And so I was fortunate enough to buy their Disney stock a few weeks ago, and I got in at 132. And so it's trading now at 144, and so they're already up 9% on that most recent tranche. Now, in the scheme of things, that doesn't matter that much, but definitely pat myself on the back. I'm glad I got in for them before that whole Disney Plus announcement. And so just few takeaways here. If you have kids, think about the gift of stock, think about custodial accounts, think about that. Two, whether you have kids or not, think about this notion that when you spend money on stuff, 100% of the money is gone. When you spend money on stocks, even if it goes down, if you buy quality, surely you can buy junk and lose it all, but I'm talking about quality. It can go down, but in general, it's a better investment than stuff. And you think about paper money too, and inflation and funny money, and what's really backing funny money. That's a whole nother topic, but just food for thought out there for all of you. A lot of wisdom, and I love Disney. I know I owe you guys a Disney stock analysis as well, so we'll get to that. So what else? I want to talk about a few more lessons before I close out the video today. I jotted down a few stuff. Let me just find it. Okay, so one takeaway, quite frankly, is it's not always the obvious pick. One of the reasons I did the analysis today, I go through all these stocks, and the obvious pick for me out of all the stocks I mentioned today is Disney, obvious for my kids, Clorox, obvious for me. But when I look at the numbers, I look at all those numbers, a non-obvious stock piqued my interest. Universal. Should I add more Universal? I might. It piqued my interest. And so what I want to impart to those watching, don't always necessarily go with the obvious pick. Run the numbers and let the numbers inform your decisioning. And when you run the numbers, sometimes it's not the obvious one. And so I thought that was a really interesting lesson from all of this analysis that I did to prepare for today's video. Another takeaway is sometimes it's fun to optimize for smaller companies. Sometimes the small caps get ignored. It's just coincidental that most of the companies I covered today are smaller. They're the ones that tend to get ignored. I own 43 stocks. I got to pay attention to diversifying by market cap. And so another reason for me potentially to pick up a few shares of Universal and maybe some Duke as well. Something else I want to talk about. This is really, really important. This is something that I learned this weekend. So I'll give you some, what happened this weekend. My wife and I, finally, we got to go on a dinner date. We went out to dinner last night, and man, we had a good time. It was kind of embarrassing almost. I almost embarrassed myself, but you know, my wife is used to it at this point. But we went to a nice restaurant, expensive meal, $150. We went big because we don't get out much. We got kids. Last time we went on a date like this was months ago. And we got to do it more frequently. Also, we had to hire a babysitter as well. And so all that ended up costing good money. Expensive experience. What was funny is putting that aside, the money stuff. Well, that's lesson one, is spend money on experiences like Disney Aulani or the dinner dates. That is never money wasted. Stuff, be careful because it loses all its value. Experience, so you have the memory forever. But what's so funny is I really cherished this dinner. It was almost embarrassing. Like I said, when I was at the restaurant, you would think I'd never been to a restaurant before. That's kind of how I was acting. I was like, oh my God, like, look at the decor of this restaurant. Like, look at the fireplace they have. Look at the decorations. Like, I was like telling my wife, like, have you ever seen anything like this? I was like, just for me, like I said, we don't get out much. And when you're in the thick of it with kids, with young kids, all the parents out there, shout out Thug Life, you know what I'm talking about. And so it's like, serious. You would think I'd never been in a restaurant before. And then it's like the food, I was like, just like, oh my God, it's so good. And it's like, but I start wondering, was it really that good? I think it was, but I also think it's because I just don't get out. I don't get out. And so having that experience because I don't get out was so special. And so what I'm trying to say here is this is actually dividend investing. This is dividend investing. It's delayed gratification. It's hard what we're going through. Trying to pay all your bills with dividends takes forever. It's hard work. It's roll up the sleeves work. It's hustling. It's thug life. It's tough. It's grinding it out. Man, it's tough. But the pot of gold at the end of the journey, it's there. And when you start experiencing it, it's magical, just like my dinner. And it's magical because you worked for it. You earned it. It took some, you don't go to it every night. If I went to the same restaurant every night, one, I'd be in bad health, but two, I wouldn't savor it. I wouldn't enjoy it. I wouldn't appreciate it the way I did. And it's the same thing with dividends. Because we all go through the struggle to live off of dividends, the pot of gold at the end of it all means that much more. And so that's just another takeaway for everyone watching today from my very weekend this weekend. But I'm serious. Like I'm going to write these guys a Yelp review because I love the restaurant that much. But it was like you would think I'd never been to a restaurant before the way I was acting. Like literally, it was a magical experience. It was just so magical. And it's like I had the champagne and we had the tiramisu dessert and like, oh my goodness, it was just everything about it. And it's like we didn't have to be feeding kids or dealing with kids. We just got to enjoy each other's company and the ambiance of the restaurant, and it was like the reward. It was the reward for all the hard work. And so I'm just saying, same thing with dividends. Don't forget about the reward and treat yourself along the way, quite frankly, to remind yourself of what's to come. And I'm at the point where I'm already spending some of my dividends and tapping into the reward of it all, but not that much. I'm tapping into just a little bit of it. I've talked about that before. All right, everyone. A lot of rambling for today, but I hope you enjoyed the video. I wanted to give some serious insights, and I want my videos to last the whole week because I'm doing one a week now, and so I want them to be longer. Spread them up into different viewing sessions. As always, I got the timestamps in the description below. I love you all. Holidays are coming up. You want a special gift for the holidays? Please consider my Thug Life investing apparel, my t-shirts. I'll link to it in the description below. Makes great gifts for the holidays. I love you all. I love your support. Thank you for everything. Really, I cannot thank you enough. We are the most awesome community here ever. I am so blessed, so very blessed. Thank you for the likes, subscriptions, all of that. Before I leave today, in terms of full disclosure, I'm long the stocks mentioned today. I am long Universal, ticker symbol UVV, Clorox, ticker symbol CLX, Hasbro, ticker symbol HAS, Duke Energy, ticker symbol DUK, and both of my kids are long Disney, ticker symbol DIS. All right. In terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video, it's just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. I'll see you in the next one. Have a wonderful day.